So thank you very much everyone for sticking around for the last session of the day. I know it's tough, everyone's hanging out for a drink, but we really appreciate it, and I'm sure you'll appreciate this next panel. So the panel's topic is credit management trends and trading conditions between the UK and Australia. On the panel, we have Patrick Coughlin, the CEO of Creditor Watch, and Lynn Darcy-Quigley, the CEO and founder of Know It. And moderating the panel, we have Tonya Berglund, Head of Strategic Initiatives at Equifax. Welcome.
Thanks, Rachel. How about we introduce ourselves first and give a bit of background on our businesses, and then we can launch into some questions. For those in the room, and we completely understand it's the last session of the day, so thanks for hanging around, everybody. We really appreciate it. So I'm sure if you're in banking and finance, you'd know Equifax. We're one of the largest bureaus, if not the largest bureau in Australia for consumer commercial fraud and identity. We are a global company as well. Originally Veda got acquired by Equifax 10 odd years ago. Let me hand to Lynn.
Oh, hi, me so quickly. So hi everyone in the room. Lynn Darcy-Quigley, I'm the CEO and founder of Know It, and Darcy-Quigley, we are commercial debt recovery. We're in the commercial debt recovery space in the UK and globally. We are also deeply embedded in the UK in the SME market, offering them credit chasing, recovery pre-litigation, and have been doing it for probably about 30 years now, so a long time. So yeah, so hopefully I can give some insights today.
Patrick.
I'm Patrick Coughlin, the CEO at Creditor Watch. Creditor Watch is a commercial credit reporting bureau, but we probably think of ourselves more of a data and technology company. So providing, AR software for everything from small businesses all the way up to some of the largest companies in Australia across trade credit and finance, but then also powering decisions with our data, typically credit reporting and credit rating sort of data as well.
So it wouldn't be a conversation around credit and trending if I didn't throw in some numbers. So I thought I'd just start off with a little bit of what the market's doing, what the trends are from an Equifax perspective. So basically in the commercial space, so business applications in general are definitely down. So we're back around 1.3% compared to this time last year in 2022. Business loans are down 4%, trade credit's down 2%, but asset finance, interestingly enough, is up 7.8%, and that's particularly prevalent in the construction, hospitality, and the professional services sector. So those sectors seem to be growing strong. Having said that, though, the insolvency rates in commercial are up 8%. So we're seeing some trends with issues in credit. That's particularly prevalent in the construction industry, which insolvency is seeing at around 49%. So if you think about all those buildings around the Melbourne CBD I saw coming in today, or yesterday actually, and Sydney for that matter, like a lot of those construction companies, possibly not the larger ones, but the smaller ones. And I know there's examples. I've got a friend building a house at the moment, and that company went out of business. So we're really seeing some problems in that commercial and particularly construction space. Consumer credit is down again, so secured finance down 3.3% and unsecured down 8.3%. And mortgages down 2.8%, this is year on year. Credit cards, however, are growing at 5.9%, so there you go. Buy now, pay later, actually the worst of everybody, 26.3% is going backwards. Personal lending 5.9% and auto loans 5.4%. Both of those are going backwards. So you can see that just consumer credit trends and the lending side of the book is definitely suffering at the moment. So in terms of credit quality, and I might just throw to Patrick on this one here, when it comes to small business and commercial, do you see much of a difference between the trend in that very small end of town versus that larger end of town when I read through some of those stats and some of the sectors? Maybe if you could talk us through, are you seeing anything sort of suffering or, some peaks going on even?
Yeah, so certainly. So I think, like at a headline, we all know that insolvencies are up, gets reported on as much as, inflation and interest rates. It's probably only back to pre-COVID. So I think what you see in the media of this huge increase is, yes, it's going up, but we're back into a normal trading environment, which is good. We've seen a big increase in credit inquiries in our bureau. So a lot more searching being done, a lot more due diligence being performed. And then if we start to break it down into particular industries, top three risky industries at the moment: hospitality, arts and recreation, and then sort of transport, postal and warehousing. All for various reasons, different reasons. Obviously there's the normal ones that I think every industry is dealing with, like inflation and the cost of rent, for example, labour shortages, but then individual things hurting transport, for example, with big increases in energy costs. What we see between SMEs and larger organisations, we collect a huge amount of payment data, so we get a really good sense of how our customers are being paid. So our customers are suppliers, they're creditors, they share their receivables with us. We're able to get this really beautiful network effect to understand that small businesses are getting paid so much slower, small suppliers, than larger businesses, which is not a surprise to most of us. It's not a case of, going back a couple of years ago, larger organisations forcing smaller businesses to pay, to be paid, at 90 days overdue, for example. And we saw the payment times register introduced to sort of call that out. Really, what we see is larger organisations are typically critical suppliers. They've got dedicated credit teams, credit policies, automated collections, debt collection teams, etc. Whereas small businesses typically don't have any of that. It's someone doing collections, and you'd know this well, Lynn, 30 or 60 days overdue.
Absolutely.
They're shy.
They dip in and out of it.
And they're shy to ask for money.
They're scared.
Right?
Yeah.
They do the work and then they don't actually ask for it. So we often see anywhere between 3 to 5 times slower for a small business supplier to get paid. So that's really what's hurting small businesses, and they have a lot less capital to actually to play with.
Thanks for that, Patrick. And Lynn, what do you see in terms of credit trends in the UK at the moment? How's that going compared to Australia?
Yeah, I think possibly quite similar to you guys. We are really being hurt by the fact that the pandemic is now payback for small businesses. So the RSLs are kicking in, the bounce backs are kicking in. Revenue is saying we gave you a quarter, we gave you 2 quarters off. Now we need paid. So, the level of winding up petitions back home is off the chart, but they're all HMRC driven. So the SME is getting really hit hard in terms of, right, now you need to pay back. That's the ATL equivalent. Yeah. So, that's what we're seeing. So that's where the SME are in real pain. The appetite to perform a proper credit check and a proper chasing facility in the UK, in the SME, there's 6 million of them. Their appetite is pretty low. They dip in and out of it. They don't concentrate on getting paid. So what we've seen certainly is that the pressure is on now because everybody wants paid, and the banks have stopped lending because the money was so cheap back then. During COVID and RSL loans and stuff, they were so cheap, they could get so much money. And the interest rates were tiny, and now they're going to try and get money and try and fund, and it's just, I think there's loads of zombie companies in the UK that are being propped up by RSLs and bounce backs. So they actually don't really exist as a company, and they're not profitable, but they're just there. So it's a scary trend.
And when you're saying credit was cheap or so much easier to get during COVID times, is that through government grants, or was that? Yeah, okay.
Yeah, so the government really held up the UK, didn't it, through COVID, which was fantastic for the companies who needed it, and I was one of them, because we literally overnight, the government said, you can't debt collect anymore, you can't do winding up petitions.
You don't have to pay bills.
Correct. Yeah. So they're telling you can't do anything, you can't petition, you can't take assets back. You need to stop, so I think getting money was just really, really easy, and getting large amounts of money, 5, 6, 7 million, when ordinarily a traditional lender would never have given you that level of money in a million years. So, I think that's the UK is going to suffer from that. I think they've given them 5 years to pay it back now, and you can get an extension to 10. But a load of UK companies are carrying a big debt level about with them, and it's a real shame.
And Patrick, did you see something similar in Australia during COVID times when the government did provide some incentives from memory, particularly around the staffing aspect too, and holding on to staff when they couldn't really pay for them in the retail sector?
Yeah, I think overall, everyone was making decisions on the fly, so we won't sort of sit here and bash the government, because I don't think any of us could have come up with necessarily a different idea. But we are certainly paying for those decisions now. I think Australia's in a much better position than the UK. Speaking to a lot of businesses over there,
I agree.
There's we're just back to sort of pre-COVID levels. Our data suggests maybe 10 to 15% above. Historical administration levels. Probability of default overall is heading back to what we look at is probably 5.8% versus a historical pre-COVID norm of 5.4. So they'll be scary to any lenders in the room. Obviously, you're not lending to all of Australian businesses, as we know, which is why FinTech's here. But it's that's going to be a lot higher. But that, I think, context is important. That's only slightly above what we see. So I think what that did, it obviously kept a lot of businesses in business. We expected a horde of zombie businesses to come around. I'm certainly on the record for saying that was coming, and it never did. I think we're starting to see a few of them wash through, which is why we're seeing quite large increases in administrations. But I think overall Australian businesses are in a fantastic position. There's two really critical horizons that they're looking forward to, which is one, some sort of official pause in rates, which we'll obviously never get from the RBA after being told rates won't go up for a while, and then some certainty around rates coming down. And I think we're almost at that first horizon that we're done with rate increases. So yeah.
And what do you see as the impact on regulation for small business? And back to you, Patrick, in Australia. And I'm thinking things along the lines of, could it be even like things like the CDR or any kind of government piece of work that's coming in that small businesses are looking at and going, this is either going to make me or break me?
Yeah, I think speaking with a lot of government representatives, what they struggle to do is actually communicate to all of the small businesses that are out there. If you asked a small business, obviously outside of this community, what is CDR or open banking, I would reckon 99.9% would have no idea what you're talking about. They wouldn't even know what screen scraping is, even if they were engaged in it. So I think that's the biggest challenge. There was talk about ASIC making searches free only sort of 2 years ago, and now they've scrapped the modern business register itself. So that's certainly not going to happen. I don't see any big changes necessarily coming, though I think that there is an opportunity to educate, and I think we've heard some really good stories from, or narrative from the from Treasury over the last sort of 2 days around CDR and that coming along, and I think there's a that's got its benefits, but it's still a while away.
Yeah, probably more the accountants of the small businesses are the ones who might actually win from it.
Yeah, that's exactly right.
Lynn, I'm just wondering if you could talk to us a little bit more about your company. And it's quite interesting. I listened to your panel just before, and the problems it's solving for, and the fact that in Australia, I think there's somewhat of a gap with this product. So it'd be really interesting if you could just talk us through, a little bit more about what Know It does, Know It All, Know It does it, and explain a little bit about the product.
Yeah, I think, having been in the credit industry for 30 years, the biggest, and obviously our mission and our challenges is to get businesses paid, small, medium, large, obviously it's sorer when you're an SME, but the lack of data and joined up thinking for the SME is really, it's quite appalling actually. So they have an accounts package. Obviously the government has pushed every SME business in the UK to use an accountancy platform, but haven't really told them what to do with it after that. They've went, we need to see it for VAT and tax purposes, but you have all this data, and we're just going to leave it there. So us spinning out Know It was, it says in the title, what you don't know, yeah? So we find the SME has all this great data in their accountancy platform, and they've got their the banking coming in. You know, they've got great data, but they have no idea what to do with it. So no, it was really created so that we can actually display the data, and then we can append everything else that happens, the credit journey. You know, where are the defaults coming? How do we reduce debtor days and increase cash flow? That's the big thing for us, you know. And is it industry trend? Is it the way that you're invoicing? Is it your behaviour that's causing late payments? You know, is your data terrible? You know, because we give them an opportunity when they do attach their Xero or their Sage or QuickBooks or whatever it may be. We bring it in and we say, look, these are all the errors in your data. How can you possibly even credit check? You know, you'll understand that, Patrick. You know, how can you credit check when you have half a name? You know, it's like, it's you know, so, and SME are famously bad for that, you know, is that whole data piece where they just don't think it's important. And I think our platform really tells them, this bit's important, get it right, and you have an opportunity to get paid quicker and faster, and you know who they are.
And what type of customers you normally see? Are they really small businesses or medium, or what's your general customer?
Because they're coming through from an app platform, you know, in the UK they probably don't turn in more over than maybe 10 million because they're coming in from a Xero or a Sage or a QuickBooks. You know, we deal with the enterprise customers on the recovery side, but they tend not to use app-based accountancy, you know, platforms. They might use Sage 50 or Sage 200, which is desktop and really legacy. We can get that data in, but it's not real and live. Whereas if we get the accountancy data and it's you know, the SME's living in it, and it's the data is live in that moment, you know, so we can look at your customers and see any distress coming down the line because we're pulling that data in. So if we see that your customer's lost 2 million, for instance, and they're due you 1 million, the likelihood is that you're going to struggle to get paid, yeah, and your credit terms are going to get pushed out. That is if you do get paid. You know, that the reality is that might be a liquidation right there. So, you know, the platform is just all about using the data, but serving it really nice down to the SME who's time poor, probably quite skill poor in actually understanding that because they're really good at what they do, but that's not really what they want to do every day.
So, for example, you might be a small business that needs to check your customers and make sure, a credit check, do you say? You do a credit check, right? They do the credit check for their customer.
Yeah, so it's really, do I want to deal with them? How much should I give them? You know, am I oversupplying or am I undersupplying? There's a benefit for both. Yeah. We would append everyone in the ledger, so the minute the ledger drops in, we just categorise everyone and we append them all with a score. So you can almost see at a glimpse if I've got a business development opportunity, or if I go, can you pay me please, and I have to stop supplying because I'm overcommitted.
So Patrick, I'm curious your thoughts on that. Do you see this is a real issue for small businesses in Australia right now, where they're not keeping track of who's paying them when, and if there's problems with the payment life cycle and the credit of those customers?
Yeah, so Creditor Watch was launched for small businesses 13 years ago. So we integrated with Xero and MYOB in those early couple of years to provide them with the credit reporting tools that the banks and the telcos and utilities and, you know, large credit providers out there use every single day. So yeah, we're doing the same thing. And what we find is, one, there's a lot of SMEs out there, and it's hard to get everyone to join up. But the ones that do realise that they see, you know, a significant increase in cash that's coming into the business, a reduction in bad debt, and they actually see growth in their organisation. But yeah, it's a challenge for small businesses generally. Anyone who starts a small business because they're an expert in construction or, you know, the latest widget. They very rarely start a small business because they're an expert in accounts receivable or credit, and if they do, they start a debt collection business.
And what sort of automation trends are you seeing with the like software automation, and are they using predominantly applications like Xero, MYOB and only that, or are they looking at, you know, other widgets, as you say, to help improve some of the problems that they're facing into? Yeah,
I think software's become really democratized, so small businesses get the opportunity to introduce automated workflow, and we're not just talking about credit and accounts receivable, we're talking about you know, the supply side, we're talking about quoting, we're talking about you know, putting together the widgets themselves rather than having people on it. They've got robotics now, so I think the increase use of software and the development of it is making it much easier to run a small business, and they can utilise it in all parts of their business, not just obviously credit and accounts receivable. So it is helping them, but at the end of the day, I think the biggest thing is that they're generally very cash strapped, and they're typically not an expert in some of those really key things, which is often finance related.
Yeah. So just thinking about some of the challenges and opportunities in that small business space, just Lynn, maybe again back to you in the UK. Do you see how are small businesses coping with the obstacles that they're facing? Because clearly we're seeing there's declines in business applications in Australia, but particularly in the UK. What are they doing to counteract some of the problems that they're seeing with late payments and beyond just some of the software solutions?
Yeah, I think to use the money in your ledger is really critical, because that's a nice bank for you. So I'm a huge champion for things like invoice finance products and stuff, because the money's sitting there, and you can use that to fund your business, fund your growth, and it's really, really important that small companies look at that. I don't think the banks are any support to any SMEs at all anymore. Almost certainly in the UK, if you're not turning over anything more than 5 million, they don't want to know you. You don't even have an account manager anymore. You're just a nothing. Yeah. They'll give you the facilities and that's it. So the banking, for me, is on its knees. There is no point in even trying to cultivate that relationship. So you need to look elsewhere. And I think, like things like Xero in the App Store, all those apps are fantastic. They're there to help you. You can get overwhelmed. I've seen customers having every single type of app under the sun, and they're just blown away by everything, and they don't often need it, so but I definitely don't think the banks are helping. I think people are making alternative moves to get money into their business now, and invoice financing is a really, really good way to do it quick and sharp. It depends industry. I have to put a caveat there. Construction find it really hard to fund invoice financing, because it's, well, it is what it is, isn't it? Construction is really risky. They're more likely to get into liquidation administration than any other industry. And in the UK, they fall hard and fast. You don't see it coming. If you were social whispering, I'm sure you would catch that there's something not quite right. But really, the liquidations come hard and fast for us back home. And I think that pace has got even more since COVID. It's increased, because 1 minute they're okay. And maybe the petitions went in, I think we are probably about 4 or 5 months in the waiting to see a petition actually hit any of the gazettes or hit anywhere, because the courts are so manual and everything is so busy. And they are still trying to catch up, from that COVID piece. So I think typically by the time an SME gets to understand that they're potentially not getting paid, it's too late.
And do you feel the same in Australia, Patrick, with just the general credit appetite of banks not really, let's say, helping the small business sector?
I don't think it's got worse. I'll say that.
Okay.
Yeah. I think the one thing about Australia is we've got a really robust, stable banking system that has seen us through some really challenging times compared to other countries, and I think we should all be really grateful for that. Could more money, more funding be available for SMEs? Sure, but it's a risk reward type of arrangement. So it is hard for small businesses, and we know that at these events there's plenty of non-bank lenders out there. Shout out button, and that there's a reason that they exist, and they've got a really, really important role to play in the economy here in Australia, particularly for SMEs.
Yeah, and just a little anecdote. Prior to my time at Equifax, I worked at Westpac, and we were looking at helping cash flow lending for small business there, unsecured lending, and it was very difficult. And I'm talking probably 5-6 years ago now, and I suspect it's fairly consistent with just the risk appetite of credit teams. It was just kind of not there. It was really difficult to just get projects like that running. we've probably only got a couple of minutes. Was there any questions from the audience, the vast audience we have?
They're all sleeping.
They're all sleeping. Was there any closing? Oh, yes.
You kind of touched on it around it's really difficult to get cash flow lending up. There's kind of this murmurings in the sort of Australian SME banking saying about lazy lending dependent on collateral, choking up SME lending. Do you have any thoughts around what actual techniques or what things we could look at to make that more possible? Understanding cash flow is probably key. What you were talking about from understanding the ledgers was fantastic. But would you have any thoughts on that?
I think data is becoming more readily available for the lender to actually see, which is important. I think there's huge challenges. The two main challenges are, if we're talking about the major banks, big older systems, right? And we can't forget about APRA. So it's not the banks going, I don't want to lend all the time. There's often regulation in place that restricts that lending as well. So there's two pretty big challenges to beat. But the data that's coming through the pipes that's available, it will be easier to pass on to the lenders in time for them to really make quicker, better decisions, or to lend to parts of the market that they may have avoided or not been able to lend to historically. Should have asked where you were from first before I answered that.
I think from a UK perspective, open banking has given the lenders and the funding, a whole different lens, so they can see more. It's no longer you submitting your accounts into Companies House and you've got 18 months to do what you want and nobody really sees what you're up to. I think the lens is really clear now for me. And open banking is wonderful, but it has its curse as well, because that transparency, there's no hiding, So, the SME is truly exposed, and I think, from a lending perspective, they're almost demanding it now back home, so ID checks is one thing, but, we're not going to fund you unless you, attach your bank account and let us see what you're up to, and do you really have money in the bank, and are you meeting your creditors, are you bouncing checks, etc., etc. So I think our open banking journey is a little bit more mature in the UK.
The UK is,
yeah,
definitely.
So the lenders are using it as a yes and no right now, and I think that's hurting the SME for sure.
Yeah, and look, I would say that that's not new to Australia, because we have fintech lenders. A good example is Prosper. So they do that. They just do it through screen scraping right now. So back to some of the conversations going on in the last couple of days too around, well, pretty soon they're looking at the end to screen scraping. We need to improve the access to small business data. And that right now that's sketchy at best. So I think there's some opportunities that we can face into in the next 12 months, which will make a big difference as well. But cash flow lending was one of the ways of being able to lend to those businesses when they didn't want to put up their home. Fair enough. Well, look, thank you very much, everybody, for your time today. That went very quick. And thank you for staying around, everyone.
Thanks, everyone.
Thank you. Cheers.